Welcome to Portfolio Playbook. I'm Damanick Dantes. Today, I want to walk you through something that's been on my mind. Markets that swing too far, too fast. Think of a pendulum. It never stops neatly in the middle. It swings wide in one direction, pauses, and then swings back, sometimes even further the other way. Markets do the same thing. Styles rotate, leadership shifts, and portfolios feel it, over the short term at least. Right now, our models continue to show major equity indices have drifted well above their trend, similar to the same time last year, though not as exaggerated as 2021, when the S&P 500 eventually fell nearly 20% once interest rate rose and snapped investors back to reality. This time around, long-term momentum is still intact, helped by stimulative policy. In price terms, the pendulum hasn't hit that ultra extreme wall just yet, but valuations, price relative to their forward earnings, do matter over the long term. When prices run too far ahead of fundamentals, history tells us forward returns shrink, especially over the next 5 to 10 years. If you're young, don't worry, but if you're about midway through your accumulation stage for retirement, you might want to consider some diversification. So, when it comes to fundamentals, let's be honest, concerns about the overspending and AI exuberance are warranted. Future revenue is uncertain, and those mega sized debt deals we're seeing today need an unusually high return on invested capital to justify themselves. That was a theme of my presentation at the Association for Corporate Growth here in New York City this week, where dealmakers and operators spent a full day talking about long-term value creation, especially in the US middle market. Generally, those are businesses that are more disciplined with capital, they carry less leverage, and they power our local communities. These companies are often overlooked because large investors chase speculation. Again, think of that pendulum. Now, don't get me wrong, innovation is real, and our team is optimistic about it, especially for our younger clients who can tolerate some risk. But all investors must remain objective, not hopeful. New technologies often hit a slowdown before adoption truly takes off, and only a handful of companies ever become the winners. It's difficult to pick these stocks, call a bubble, or time a peak. That's the job of a media pundit who captures emotions instead of long-term steady returns, not a true portfolio manager. That's why our relative strength framework has been shifting. Instead of letting the pendulum yank us towards whatever is currently popular, we let the data recenter the portfolio. Recently, that's meant leaning into global value, paid for by trimming our long-standing US equity overweight, which has gotten too expensive, and frankly, it's crowding out better opportunities elsewhere. So let's slow down for a second and define some terms, because jargon isn't helpful for everyone. Value stocks are companies trading at low prices relative to their fundamentals, like book value or earnings. When I say growth stocks, those are stocks trading at higher prices because investors expect faster growth. The value premium is simply the historical tendency of value stocks to outperform growth stocks over long periods. And that history is real. For nearly a century, value has beaten growth in the US by roughly 4% per year on average. In the years when value did outperform, the premium was pretty big, about 15% on average. But it doesn't show up every year. Like that pendulum, it comes in cycles. We've seen long stretches of value leadership. Think back to 1985 through the early 1990s, and again from 2001 to 2008. And then we've seen the opposite, massive growth stock out dominance during the dot-com bubble, and again from 2008 to 2021, fueled by low interest rates and easy money. So how do we invest through these cycles without getting some whiplash? For us, it starts with blending value and quality. Quality stocks are companies with stable earnings, low debt, and resilient cash flows. They tend to hold up better in downturns and avoid that classic value trap, a stock that's cheap for a reason. No one wants it, so it remains cheap and just lags the overall market. But by combining value and quality, we basically steady that pendulum. Value acts as an upside boost when sentiment normalizes and fundamentals matter again. Quality keeps us out of that junk and provides resilience when the market cools off. And together they smooth returns across cycles and gives us exposure to long-term themes without paying speculative prices. And here's what's important. We're not shifting the entire portfolio to pure value. That would be flat out foolish, especially in a late cycle environment. So instead, we're building a global blend of value, quality, and quality growth, especially in countries that aren't at the same stage of the economic cycle as the US. Quality typically holds up in downturns, but it still participates in long-term growth trends. And globally, quality's valuation today is back to its long-term average after lagging megacaps for years. Another sign that the pendulum may be preparing to swing. So here's a takeaway. Don't treat markets like a game. That's not how compounding works. Cycles always turn, leadership always changes, and portfolios should be built to last through those swings, not to chase them. Thanks so much for listening. We dive deeper into this topic on our Substack available for premium subscribers and clients.